if we don't have a recession, if we don't have a credit crisis, we are going to have a blow up in the bond market just because we have so much fiscal and monetary madness going to happen in 2026. And I think if those bond yields go north of 6%, I think that completely submarines the housing market and completely blows up the credit bubble, obviously, and also the equity bubble.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was on this channel earlier this year, he warned that a triumvirate of three massive asset price bubbles in credit, real estate, and stocks threatened to take down our fragile economy and dash the retirement hopes for millions. But since then, the bubbles have only expanded. So, will they expand further or pop in 2026? To find out, we've got the great good fortune to welcome money manager Michael Pento back to the program. Michael, thanks so much for joining us today.
Hey, I'm looking forward to a great conversation, Adam.
It is always a great conversation with you, Michael. I'm looking forward to this too. Lots to talk about. Not a lot of time, so we're going to have to just bang through a bunch of stuff as quickly as we can. So let's start here. So the day we're recording, Michael, it's Friday. Yesterday, Thursday, market close, record high for the S&P and for the Dow. Kind of riding a recent sugar rush with the recent Federal Reserve guidance and Chairman Powell talking about how the Fed is going to be buying $40 billion worth of T-bills going forward. Markets interpreting that as QE light or maybe just regular QE. So anyways, you've warned about these bubbles. They seem to continue being blown here. Let's start there. As we look into 2026, is it just going to be more of the same, or do you think there'll be a reckoning at some point next year?
Okay, so if you don't mind me answering the question this way, so let's just go back on a timeline. So my IDEC model on November 6th said it was time to get a little more defensive. So we started the year bearish, as you remember, cautious. April 2nd was Liberation Day. April 9th was we recanted all of our Liberation Day tariffs, or most of them, at least the levels. And then we went bullish, and I've been on your program several times saying that we're not max bullish, but we were 40% long the market until November 6th. That's when the IDEC model began to tell me, hey, start getting more defensive, and I did. And the reason why, I'm glad you're having me on, I want to walk the audience through what I saw and what I see now, and then we can talk about 2026. So I noticed that on November 6th, financial conditions stopped easing, and credit spreads began to widen out. So that had me thinking, well, why would that happen? Is it just a fluke, or is the move substantiated? So then I looked at the reverse repo facility, which effectively is zero. These are the liquidity metrics that I look at. The level of the real Fed funds rate had been in positive territory for 2.5 years, which in previous cycles indicated it was time to get bearish, because that's when you'd have a sell-off in the market. Bank reserves had been falling for the past few months, and the slope of that line was increasing to the downside. And the yen carry trade, again, there'll be slides on this stuff later in the show. The yen carry trade started to erode significantly, which is basically, just real quick, people, mostly institutions, borrow in yen, they sell the yen and buy various currencies across the globe, their bonds and their stocks, and they get a much higher yield. And they also get a currency appreciation with that too. When they repatriate back into yen, the yen has usually declined. It's a huge source of liquidity, and that has dried up, or it was drying up. Then I look at some AI credit default swap spreads, in particular Oracle, and they were blowing out. And the last thing I looked at in my model, these are all things in my model, was the MOVE index, which is a measure of bond market volatility. That was spiking. So for those reasons, I sold down the equity exposure from 40% to just 15% net long. Then on November 13th, the Fed funds, this is before November 13th. So the model is very, very robust. I picked up on this trouble before. November 13th is when the Fed funds futures market said that there would not be a rate cut in December. it went below 50%.
Yep.
And in that 1 week between November 13th and November 20, was it November 21st that I emailed you? I think it was November 21st. The S&P dropped 5%, the Qs dropped 6%, and Bitcoin went down by 20%. So everything went to an R squared correlation of 1 in that week. Everything planned. Even silver and gold was being sold off.
Yep. And I just checked. It was November 21st when you
Okay.
emailed me about that.
And on November serendipity for me, when I told you that I had been selling on November 21st, New York Fed President John Williams came out of the blue. Maybe not so much, Adam, but maybe out of the blue, said, "Oh, by the way, we are going to cut rates in December." And the Fed funds futures market went to 90% that we were going to have a cut. And then, of course, on December 10th, Jerome Powell proved himself one of the great alchemists, one of the greatest counterfeiters in history. Not only did he cut rates again by 25 basis points, but yes, he entered into a $40 billion per month QE program. Now, some people are saying that's not QE. I would argue that till I'm blue in the face or dead, because when you expand the Fed's balance sheet, when you print money ex nihilo out of nothing, and you're buying short-term bonds, I don't care why you're buying them. I don't care if you're buying them to bring down the rate or keep money market rates stable to hit your target. You are expanding the Fed's balance sheet by creating money out of nothing, credit, high-powered money. Fed credit is the same as cash. It's electronic cash. It can be converted to cash. That's why it's part of the high-powered money aggregate. They're blowing that up by $40 billion a month. So yes, we are in QE. And that has put a lid on the deterioration of financial conditions and sent credit spreads into a period of mollification. They were being mollified as of this recording. And then we have today, we see some, I think my theory is it has more to do with the AI bubble bursting, and we can get into that later in the program. But there's two salient risks for 2026, and one of those risks is the AI credit bubble is going to burst, and so that's what I think is happening today. But that's where I was. That's a recap of 2025 in a nutshell.
Okay, and for folks that they're going to watch this a couple days after we record this, Michael, but who weren't paying attention this Friday that we're talking, what about today's action is making you think that the AI bubble may be starting to break down?
Well, we had earnings out on, I believe it was what was the big AI company that came out on Avago, right?
Okay.
AVGO. And they said they beat on the top line, they beat on the bottom line, and then it turns out it looks like financial alchemy on their balance sheets. That's what people are seeing right now. In other words, this circular financing and there's all kinds of, and this is I'm not a forensic accountant, but they are being accused of accounting gimmickry, and that's why the stock is crashing and is bringing down the whole market with it. Because listen, Adam, if you take out AI from earnings, look at the NIPA tables, earnings are falling. So if you take out the AI stocks from the earnings complex, EPS is dropping on the S&P 500. And if you take out the companies that deal with AI, you don't have much of a gain in the stock market. And you don't have much of a gain in GDP either. It's all about this financing of the AI bubble, which used to be, was the foundation was built on cash flow, and now it's borrowing hundreds of billions of dollars to buy these chips. So it's just another example of this magnificent credit bubble, which is part of the triumvirate of bubbles that include equity prices and real estate.
Okay, and I want to note too this week that Oracle suffered a big drop, and largely I think because its capital expenditures on AI were even bigger than what Wall Street was expecting. And I know Oracle, they've had a lot of questions about, man, is this company going to actually be able to finance what it's told us it wants to build out here? So anyways, there does seem to be sort of a questioning of confidence in the space that we're seeing this week. I think Broadcom also had a similar
Well,
size sell-off, that
AVGO,
13%, something like that.
yeah, that's what I was trying to get out of it.
Oh, Broadcom. Okay,
Broadcom,
yeah.
as the symbol is AVGO for Broadcom.
Okay, yeah. Okay. So we're seeing some very big players, and folks may remember Oracle added a ridiculous amount of market value at its last earnings call because it was announced it was going to do all this spending for AI, and this big blue chip tech company, added like 40% of market value within a matter of hours. I think we're starting to see the bloom coming off that rose. So, is this the end of the AI bubble? I don't know, probably too early to tell, but definitely these are some of the initial signs you might expect to see. So more to come. Okay, so you just recapped 2025 for us. You gave a quick mention to some of the slides that you prepared, Michael. Because we are a little tight on time, I want to make sure that we get to them and we don't shortchange them. Should I pull them up now?
Sure, go ahead.
Okay.
Put a little color on more of what my model looks at and what I was seeing and why I was able to shed some of the high beta exposure before we had that big swoon. The S&P and the Qs, everything was dropping. Interesting, as my theory holds again, and it's proven out that everything goes to a correlation of one. When you see this, rapid disinflation or deflation or some kind of chaos in the bond market, which I will talk about 2026 too. So first, the first slide is it's just a chart of the real Fed funds rate, and in particular, you can see that the level of the real Fed funds rate has been positive for 2.5 years. That's the very right side of the chart. And that's most relevant because it was mostly negative. We had a negative real Fed funds rate from 2001 all the way to 2022. And you could see what happened right before 2008. You see the real Fed funds rate spiked up about 2.5 years, and then we had a collapse in the credit markets, the housing market, and in the stock market. So my model here looks at also bond market volatility. This is the MOVE index. This is from Merrill Lynch. And you can see just on the right side of the bond market volatility started to spike in very, very early November. And that was another reason why I went a little bit shorter on my exposure with equities. It's since come down a little bit, but it's spiking back up again. Reserve balances, bank reserves have dropped $1.2 trillion since 2021. Now, what makes reserves disappear? Two things. Quantitative tightening is one, and the other one is bank runs. When you go to a bank and you take money and you withdraw it, their reserves are drained. And look at this precipitous slope over the last few years here since 2021. And that's what, if you're ever, we can talk about it ad nauseum. I know we're short on time, but if you want to ask yourself why, after almost 5 years of missing your inflation target to the north, that you would dare to cut interest rates for the third time in this, 3 meetings in a row, it's to protect banks and to keep interest payments low for the Treasury. Those are your two. It's not about the middle class. It's not about employment. It's that those are straw men. They are reasons to obfuscate the truth. They are in business to protect banks and to make the Treasury solvent, and that's the only reason why. That is the main reason why. Believe me.
And Michael, there's a term out there called fiscal dominance, and in a nutshell, it basically means you get to a point where the central planners have to kind of abandon any and all other mandates that they have, price stability, unemployment low, whatever. They have to sacrifice it all just to keep the debt serviceable.
Yeah.
In your opinion, are we mired in fiscal dominance now?
Yes. When you have $1 trillion in interest payments, that was the watershed moment where I think that's the only cogent, reasonable assertion you can make, because looking at all-time highs, you just mentioned all-time highs in the stock market other than today. Financial conditions are still pretty easy. You have an unemployment rate that's way below his historical average. Home prices are unaffordable for most Americans, and you've missed your inflation target for almost 5 years. if I just mentioned all those things, which are all facts, they're not my opinion, they're all facts. You would say, well, the Fed is raising interest rates. They're not cutting. They're not cutting 3 times in a row and going back into QE and being told by the administration that they should have went by 50 basis points, if not more. It's all about keeping debt service costs low and keeping banks solvent.
Okay.
It's not about the middle class, unfortunately. So on slide 4, you see these are the reserve balances. I just talked to, no, that's slide 3. Slide 4 is the reverse repo facility.
Oops, sorry.
Yeah, sorry, I skipped ahead of you.
No worries.
It's effectively zero. Look at the right side of the screen there, down from $2.5 trillion in 2022. So these slides are showing why we have a liquidity problem in the markets. Positive real Fed funds rate, causing bond market volatility spike. Reserve balances got very low. Reverse repo facility, which is fallow excess reserves being parked at the Fed that went into the bond market. Well, they're gone now. And that's why we're doing 40 billion in QE. Slide 5.
Sorry, before we move real quick, let me just make sure folks really understand this. So think of the reverse repo facility as a big sponge. And when you put a sponge, say when you submerge it in water and you pull it out, the sponge is saturated with water, right? And that's pretty much where we were when this reverse repo facility was at its highs here. The sponge had a ton of water in it. So as you squeeze the sponge, it's pushing water or liquidity out of the sponge into the world, right? And so it's this nice tailwind for the markets. It's this excess liquidity. It keeps everything running, lubricated, creates extra liquidity that can go into asset prices and push them higher, and everybody's happy, right? So now we've got to the point where the sponge has been squeezed dry, right? And so we're not getting that extra liquidity anymore. And so that was probably what your model was picking up on, Michael. So you can have a problem with a dry sponge, but to refill, like if we wanted to refill the repo facility, well, that's a sponge that's sucking water out of the system. And that would create even bigger problems. So the Fed is sitting in a challenge here where it's like, well, I got this dry sponge. It's not providing the tailwind anymore, but I'm afraid to start refilling it because it'll shift those tailwinds the system used to have into headwinds. So I just wanted to sort of help folks understand where we are specifically with the repo facility. Now he can help out by providing liquidity other ways, which is part of what he just announced.
Yeah, I mean, they could flood the banking system with reserves enough to fill a reverse repo facility, but it would have to be more than $40 billion a month. It would have to be like 100 billion a month, some number like that.
Yeah.
Banks would have reserves, they could hold on to reserves, and they would park reserves at the reverse repo facility, and it wouldn't make a difference to them. But that's not, we don't have that yet. As a matter of fact, that reminds us of something else I want to make sure I mention before we run out of time, is the first Fed meeting of the new replacement, what I like to call affectionately as an obsequious sycophant of the administration, who I mostly support and voted for, just a caveat. Kevin Hassett is the odds-on winner there. He doesn't get a vote until June 17th. So not only you have to ask yourself problems that could exert themselves as far as exacerbating the liquidity crisis that was happening starting on November 6th. You could say, well, is one rate cut between now and one more? That's what that's what the markets are projecting. One, maybe two at the most, between now and June 17th. Enough? Is it going to be enough to provide the liquidity for the bond market? Is $40 billion in QE going to be enough? I mean, probably is. I don't know for sure. My model will watch it assiduously. But the question is, do you want to just ignore that fact? And I wouldn't. I would pay very close attention to it. So now slide 5, Adam, is the Japanese benchmark yield, benchmark treasury. So the benchmark yield is at an 18-year high. And don't forget, the yield range between 0 or below between 2016 and 2021. That was under Shinzo Abe and his interest rate repression regime, where he capped 10-year note at 0. But when you have a quadrillion, I think it's like 1 point. Yeah, here I wrote it down here. So the new minister, and I won't pretend I can pronounce her name correctly, Sine Takachi, she went to add $21.3 trillion yen in a stimulus program. And that added to the $1.3 trillion yen in debt, which is 240% of GDP. So this rise in yields, which is
Wait,
dragging
you said trillion. Is
trillion
it
yen,
a trillion or is it quadrillion?
it's 1,300 trillion yen. So it's 1.3 quadrillion yen. Thank you if
Yeah.
you corrected me. I don't know if I don't know if I misspoke, but it's 1,300 trillion yen. So, that's a lot of yen, right? So, so they have abandoned their interest rate repression, where the BOJ was just buying every JGB auction,
Yep.
the central bank. They abandoned that, and look where yields are going. They're going up, up, up and away. Um, and the last slide that we have
Yeah.
is the
So
yen.
sorry, but before we get there, so hey, this endangers the carry trade, which you talked about earlier. But just to underscore, that's been just sort of a huge component of how markets have worked over the past couple of decades.
Yep.
So if that goes away, and TBD whether it will or it won't, but if it does, I mean, the system it's like losing a limb. Like the system's going to have to learn how to operate differently. And it's going to be curious to see how it does that. Also, Michael, I had heard it said, years ago that Japan was so over indebted and, having a quadrillion in debt, it catches the attention. But it was so over indebted, especially on a debt to GDP basis, I think in most of any country, that I'd heard it said once that I think back when yeah, yields were, I don't know, back in 2022, they're what, like 0.5% or something like that in the 10-year. I had heard that if the 10-year treasury in Japan rose to like 1 or God forbid 2%, that it would just blow up the economy there. It would just blow up the
Mhm.
country. Is that a real danger here?
Yes. The short answer is yes.
Okay.
Absolutely. Yeah, when you have 1,300 trillion yen in debt, 240% debt to GDP, your economy stops functioning as rates rise. And it's not only the actual level, which is almost 2% now, it's the rate of change. This was zero or below in 2021. So it's the rate of change that I'm really watching here. And
Right. But
I
like
think I
throwing a
think
person into Arctic waters, you just, it's a shock to the system.
yes, yes. And it's dragging yields higher across the globe. So um, we'll see what happens there. But
So,
that's
so is
why,
it safe to say, let me just ask you this, if yields don't come down materially from here, what do you expect? I mean, do you expect Japan to just grind to a halt and enter
yes,
into a deflation?
I expect the BOJ to go back into interest rate repression, where they just put a cap on the yield on the 10-year. I that's what
Okay.
that's what I expect will happen. I don't know if it's 2% or 3%. I don't know the level, but I expect that to happen.
Okay. All right.
Uh,
Sorry to interject, but those were important questions.
yeah, always. So the yen carry trade is eroding. The estimates for the size of this carry trade, which is, it's important enough for me to put it in my model. It doesn't just get there by osmosis. So I back tested everything. And the reason why it's there is because the yen carry trade, as you said very eloquently, is that it's a major source of global liquidity. And when that dries up, there's a huge problem in funding markets. So the size is between $4 and $20 trillion, the entire size of the yen carry trade. And the blue line on this chart represents the US 10-year and the JGB 10-year. Now the spread between the two was 400 basis points in 2023, and now it's about 200 basis points. So you're getting to the point now where when you factor in currency protection, currency hedging, that you can no longer make a profit by borrowing in yen and buying up the U.S. assets.
Hmm.
So it's those six reasons that I mentioned that caused me to get more cautious. Now, in all honesty, yesterday I went a bit longer on some healthcare stocks just to bring the portfolio up to 20% net long. But given where we are at a total market cap of equities to GDP at 200 and almost 230%, which is, into the thermosphere of valuations, you have to be very careful. And if you're out there 100% long AI stocks in an S&P 500, equity only portfolio, you could be in a world of hurt in 2026. I want to make sure we get to the three reasons why I think there could be trouble in 2026. But I just want to wrap up this PowerPoint so people understand how my model works, what got me, more bearish on November 6th, what saved us from losing money then, and what we're looking at going forward to make sure we make the right decision. Well, if credit spreads start to come in again and stay quiescent, and financial conditions continue or start to ease again, while we'll be going long, because a lot of these slides will start to be to mollify, or the opposite, when we will finally go net short and start riding the four horsemen of the economic apocalypse, which is a tremendous opportunity to not only protect your money, but to profit from the demise of this massive bubble that we've built in equities. And when I say we, I mean mostly I'm pointing fingers to the Federal Reserve, the ridiculous malfeasance that's going on there.
True, although Congress is similarly complicit with their wanton spending ways that the Federal Reserve has been helping enable as well. Okay, so lots of blame to go around, but I agree. Fed central character to point the finger at. Okay, so let's talk about the specific concerns and risks and how you plan to sort of surf 2026. But real quick, you had all these concerns last week. Post the FOMC announcement of the 40 billion per month, do you feel like that is pushing off the reckoning a little bit now? Is that buying the Fed extra time here? Is it pushing some of your concerns a little bit further off in the timeline or not?
According to my model, it has. It bought some time for sure. Because like I said, its financial conditions stopped. They were easing. They stopped easing. They started to tighten, and then they're getting easy again. And if you look at credit spreads, they started to narrow again. So that just tells me, based on all the components of my model, that it's time to get a little less cautious. And which is exactly what I did. This is why yesterday I went and bought some more healthcare and added 5% more net long to the portfolio.
Right. You went from 15% net long to 20% net long.
20%, correct.
Okay, yeah. And sorry, I should have asked this earlier. What sector does your model, is it in right now?
We're in sector 3 right now, bouncing around. We went to 4, then we went quickly to 2, and now we're into 3. So things are moving.
And I'm sorry, I know we do this every time, but can you just very quickly name what every sector is so folks know?
So sector 1 would be rapid disinflation or deflation and a recession. Sector 2 is just a mild disinflation. Sector 3 is stasis. Sector 4 is reflation, and sector 5 is stagflation or intractable inflation. And in each sector, back tested rigorously, you'll see what stocks, what bonds, what currencies, what commodities you should own, and it varies greatly. But I want to what happened in the past few weeks should hammer home how over financialized and how fragile our entire economy is. I mean, just having the idea that we wouldn't get a rate cut in December because reserves were getting a little scarce. And I pull up a chart look at that chart on reserves. Reserves were non-existent. I mean, they're very, very minimal for many, many, many decades. And then they spiked up to like 3 trillion in reserves. And now they're down. But they're not down relative to where they were a decade ago. They're just down to where they were in 2020. But just the rate of change caused the whole system to freeze up. And in those 6 days, we saw the S&P 500 drop 5%, QQQ is down 6%, Bitcoin down 19.5% in just 6 trading days. And the only thing that ameliorated that process was the fact that the Federal Reserve had to step in and launch QE and cut rates. That's how fragile the system is. And it's very sad that it's become so dependent on never-ending continuous interest rate repression and debt monetization and money printing from our Federal Reserve.
Okay. So, Michael, some people would say, yeah, I get all that. So maybe it's bad, right? Maybe you think it's bad that the system's dependent on this, all this stuff. But if prices keep going up and I own assets, why should I care?
Well, you should care because there'll be a time. Here's a succinct answer. I'll try to be succinct as possible. There will be a time when that very process just leads to exacerbating the inflationary process, which leads to a spike, intractable spike in long-term interest rates. And if that's the case, there's nothing they can do. I mean, you can't stop a problem where the bond market's blowing up because of inflation by creating more inflation.
Mm-hmm.
That doesn't solve the problem. And you can't fix an insolvent nation by launching more rounds of helicopter money. So when the long end of the bond market finally blows up, and it will, then you see these asset prices will crash concurrently. Credit, real estate, and equities. That's why you should care. And people say, well, didn't we have a problem in 2008? We had a crisis in 2008. We had a credit crisis. We had a housing crisis. We had a stock market crash. Why can't they just do the same thing again? Well, first of all, you have to think about what's different. First of all, the total market cap of equities as a percentage of GDP was 107%. Now it's close to 230. But that didn't stop the stock. When it was 107% of GDP, the market still crashed by 50%.
Mm-hmm.
So imagine how much it's going to crash. And they started manipulating interest rates lower in the summer of 2007. The market didn't stop going down until March of 2009. So just because the cavalry is riding to the rescue doesn't mean they've reliquefied the system. That didn't happen until rates went from 5.25 to 0, and Bernanke was buying 80, 90, $100 billion of bonds every month.
Right.
Mortgage-backed securities, to be specific. So there's a salient elevated risk that the next time they come to the rescue, because of the insolvency that we now have as a nation, insolvency meaning we have $2 trillion deficits, $1 trillion in interest payments, total debt to GDP is now 125%. It was like something like 80% back in 2007, much lower. And we also have an intractable problem with it, not intractable, but I don't use hyperbole. We have a problem with inflation getting back to target. Whereas in 2008, the problem was, we were wringing our hands. We just can't get inflation to 2%.
Yeah, quote unquote, too little inflation.
Yeah. So for those three reasons, things could be very different next time.
Okay, great. And I just condense that even more to say, the more distorted the system gets by the policies that are used to stimulate, you increase the risk of a dramatic downward repricing when things go off the rails, right, which you just described. The other thing I would say along with that too is because those policies in general are inflationary, you are damaging on an ongoing basis the purchasing power of the economy. So you kind of end up with the worst of both worlds, where you're down the road, your dollars buy less, and then you have a lot less dollars because you've had a big repricing in the asset markets, right? So you kind of get the worst of both worlds. And then I guess the third thing is none of that does anything good constructively for the nation, right? You end up with a damaged nation, a damaged economy, a damaged populace. There's just no good about it in the long run.
Adam perfectly said, but I'd add to that, we already have the bottom 80% of the economy, the consumers have been, severely injured. It's only the top quintile that's really working.
Yeah. Let me ask you this, sorry to interrupt, but so I talk about this all the time, and people have heard me talk about not just the K-shaped economy, but I think it's in danger of metastasizing into a lowercase I-shaped economy, right? Yeah. Just put on your bullish hat for a second, Michael. What could get us out of this? What could get the bottom 80%? Let's look with the 5-10 years down the road. What could happen between now and then where we could be talking about how, hey, it's no longer a K-shaped economy and everybody who's, that bottom 80% is feeling a lot better now?
I guess you'd have to.
I ask just because I have trouble coming up with that answer.
I guess it would have to be an artificial intelligence productivity miracle where the massive increase in supply without damaging labor too much.
But how do you?
Well, you asked me to put on a bullish hat, which I don't really, I don't own many of them, So,
well, and I understand why, but let me just clarify. I don't think you're a bear. You're not a perma bear, right? You're just a practical guy. You're a realist.
Yeah. As anybody can pull up the tapes from our interviews, I turned very bullish in late April after being bearish at the start of the year and rode that, wrote a very nice return for me and my clients this year. So, um, but now I'm a little more cautious, and the reasons why I can go through quickly if you want me to go through the three salient risks for 2026 if we still have time.
Please do it unless I interrupted you and you actually had some magical solution. I shouldn't say magical, some convincing solution why we should feel optimistic about the bottom 80%.
Well, I believe in mean reversion. Nature hates vacuums. I can't come up with one example in history where you saw the numerator of say the total market cap of equities or home prices stay where it is and had GDP and incomes catch up. The bubbles don't burst that way. They burst violently where the numerator and denominator both go down together. And then until they have some kind of mean reversion and normalization. So that listen, I'm open to the idea. I hope and pray that it happens. I just have never seen it before, and no one else has either.
Yeah.
But if that happens,
I guess my answer to this question, as I think about it, is I can see the wealth gap narrowing over the next 5 years, but it's not because the bottom is getting pulled up. It's because the top is getting pulled down. Yeah.
right. That's egalitarian socialism. So everybody's equal. We no longer have a lower case I economy, but everybody's
Right. Well, and that could be because of political means where there's, confiscatory policies or whatever. But also, I'm just thinking more about your part, which is, hey, we've got I mean, we haven't even talked about the CAPE ratio and the Buffett indicator and all that stuff, but we're at all-time high, valuations. But to your point, the system could just, start to really break, and then we get that big correction, that big reckoning in asset prices, and that would bring the top 10%, down.
Yeah. So when I say total market cap of equities to GDP, that's the Buffett indicator, and if the Buffett indicator says that the average return for the next 10 years will be -1%. And I don't think it's going to be -1. It's going to look more like -50, -60, and then up 100, something like
Right.
that, close to that. So you want to be, that's why I make a very strong argument for active management. Active management with a robust, smart model that works, that you can get out of harm's way when this stuff really starts to, I call it the great reconciliation of asset prices, which is guaranteed to occur. It's just getting the timing right.
Yeah.
That's what we try to do here.
So I find I'm really starting a lot in the past couple of weeks, been making the exact same case. So, and of course, that's exactly what you do. So we're getting right into your wheelhouse here. Before we talk a little bit more about that, though, I think I interrupted you and you were going to talk about your three big outlooks for 2026. I want to make sure we don't miss that.
Okay. So the three dangers of 2026 are number one is, and this is, I guess this is the in ascending probabilities. So number one is, and this is the lowest probability, that we only have one more rate cut between now and June 17th, and the $40 billion in QE isn't enough. And even if that is the case, and we have a liquidity crisis and a credit market crisis, and a bond market frees up, money markets freeze up, I think Powell will react, if he's still there, will react almost immediately and just flood the system with money. Of course, the dollar will get destroyed, and we can get into the allocation where I think at the end of this conversation, where you should be allocated with your assets if that's the case. A little slightly higher probability is that the AI credit bubble bursts. Hundreds of billions of dollars are being borrowed now, not cash flow any longer. It's borrowed funds being thrown at this. And this, to me, is even, I'm not disparaging AI. This just smacks of the overinvestment that occurred in 2000. We're buying switches and routers and fiber optic cables, just not because the internet was a false flag of a technology, and it wasn't that it wasn't going to be massively in accretive to productivity. It's because Wall Street just went crazy like they always do.
Right. And with every technical transformation like this, we overbuild too quickly, and then it takes a while for the economy to fill out the full potential.
We buy too many. We buy too many of these chips and build too many of these data centers, and the economy needs to reset. But the highest probability is the fiscal and monetary madness. So we're starting at $2 trillion. That's the baseline deficit for fiscal 26. Then you add to it $1,000 for every child born that's being floated out there.
Hmm.
$2,000 checks to everybody who makes under $100,000 a year. That's being floated out there. We naturally, because the one big beautiful bill, we're going to have big tax refunds going out in April. That's the fiscal impulse, and then of course, you have the monetary impulse. You have Kevin Hassett who said, "Hey, listen, there's plenty of room to cut interest rates," and even Austin Goolsbee, who actually dissented and said, "You know what? I don't think we should cut rates." Even he came out and said, "You know what? I think we can cut rates a whole heck of a lot next year. It's just not the right time." So I mean, you can imagine if we have 3%, 3.5% GDP growth and real GDP growth, and then you have 3% plus inflation, that's 6.5% on a nominal 10-year yield. That's why I shorted the 10-year note yield when it was 4%. And so far, I've been only marginally correct. I think I'm going to be wildly correct. If we don't have a recession, if we don't have a credit crisis, we are going to have a blow up in the bond market just because we have so much fiscal and monetary madness going to happen in 2026. And I think if those bond yields go north of 6%, I think that completely submarines the housing market and completely blows up the credit bubble, obviously, and also the equity bubble. I just want to add one anecdote. I have a couple of houses here in Florida. One house that I have in Naples, Florida, is already down 20% from where I bought it in 2022.
Well,
I'm no
okay.
I'm no Nick Gurley, I'm just I'm just telling you from what I could see. And guess what? People say, well, it's only Florida and it's only the Sun Belt. Well, that's where all the people move to, and that's where all the bank loans sit in. All those bank loans that were made from 2020 to 2023, they were all made to the people moving out of the Northeast and the Midwest and coming down to the Sun Belt and buying asset prices, homes that were way overvalued and unsustainably so. So there's going to be a lot of bank distress as well.
A lot of bank stress. Okay. And I should note too that despite uh, the announcement of 40 billion a month for getting back to ample reserves and all that stuff, the 10-year bond is still at 4.2.
Yeah.
So it hasn't come down at all.
Is it 4.2? I thought it was more like 4.12, 4.12.
I'm looking at it right now, and it's at 4.194.
4.19, so almost 4.2.
Yeah, so almost 4.2.
Not 4.02. Okay. Gotcha. You're correct. Sorry. So that's the wrong direction from where, I mean, that's the right direction for me because I shorted, but 4.2 is nowhere near where it should be. In nominal GDP, I mean, Atlanta Fed has us at 3.5%. And that's before we have all this fiscal and monetary madness kick in. So there's a very cogent argument to make that the bond vigilantes wake up. That's the highest probability of why I think this thing can crash, because you'd have a credit market train wreck and chaos in 26.
Yeah, and all I'm saying, giving validation to your point here, is that despite the 3 rate cuts that we've already had, and then now the cessation of QT, and now the announcement of QE or
QA.
reliquification, whatever you want to call it,
Yeah.
the 10 years not coming down at all.
No, no. Why would it? Why would it come down when not only my nominal GDP argument, if you don't like that, when we're pursuing more inflation, when we haven't gotten back anywhere near to 2%, we're closer to 3. Why would the long end of the bond market do anything else? Doesn't make any sense.
Right. Well, it's making sense to you, and you've made your your bet on it. And yeah, if to your point, we get even more, what are you saying, monetary mayhem in 2026 that the vigilantes don't like, and they take it high enough to break the housing market and break the other parts, and the banking system's under stress from like the loans you were talking about. Things could go caterwonk pretty quickly. All right. Well, look, we only got a couple of minutes left, Michael. So 2 really key questions. I'm going to ask one I usually ask at the end, but we'll put it up here at the front before I ask the second question. For people that have A, enjoyed this conversation, B, enjoyed all my past conversations with you, feel that you've got a really good read on things and you've got a good model that's helped guiding you here, where should they go to learn more about you and your work, and potentially even if they want to become a client of yours?
Well, thank you, Adam. Pentoport.com is the website. I have a midweek reality check podcast for $50 a year. It gives you the interpretation, my interpretation of the salient economic data. And if you are a US citizen and you're qualified for a long, short, actively managed strategy, and you have $100,000 a US citizen, I will directly manage your money in the inflation, deflation, and economic cycle portfolio.
All right, great. And Michael, when I edit this as usual, I'll put up the link to Pentoport there on the screen so folks know where to go. Folks, the link will be in the description below this video too. All right, so in wrapping up here, you talked about, hey, if things start getting, rockier this year, your model obviously will shift into different sectors and tell people how to invest. So if the year goes the way that you think it could, talk about how your allocation would change from sector 3 stasis moving through sector 2 into sector 1.
Well, it depends on what's the catalyst for the chaos,
Okay.
what's happening. So if it's a blow up in the liquidity because one more rate cut didn't quite do it, and the $40 billion a month didn't quite do it, we'd be moving towards sector 1, which is rapid disinflation, deflation, and recession. So that's where the 4 horsemen of the apocalypse come in. So you have cash, you've got short-term treasuries, you've got the US dollar, which you want to own, and you'd be shorting the stock market. On the other hand, if it blows up because of runaway inflation, I would increase my short in the bond market, and I would buy base metals. I actually would increase my energy holdings as well. So right now I'm in and out of silver. I've owned gold and platinum for a long time, and I own energy, and I would be increasing all those positions as I short the bond market, the long end of the bond market. That's where you'd see the word, because the stock market can go down along with bonds, just like it did in 2022. So asset prices go to a correlation of 1, and everything gets flushed down the toilet.
All right. Michael, I hate to wrap it up here more quickly than normal. I love to go long with you normally. We'll just have to rectify that early in Q1. We'll have you back on in January to give us a sense of kind of a real-time audible about where things are. And just in wrapping up real quickly, 2 bits of housekeeping. One, if you'd like to talk to Michael, obviously talk to Michael. Go to pentoport.com. If you've got questions about how to manage your portfolio for next year, position for a lot of the things that Michael and I have talked about. If you don't have a good professional financial advisor who's advising you through that, feel free to talk to one of the ones that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. These are the financial advisors you see with me on this channel week in and week out. These consultations are totally free. And there's no obligations involved. It's just a free service they offer to be as helpful as possible. Also want to remind folks too, if you haven't seen it yet, Thoughtful Money is a precious metals endorsed provider. It's Andy Sheckman's company, Miles Franklin, is offering exclusive for Thoughtful Money followers while supplies last. They're offering junk silver for $1 under spot price. And as you've seen this week, silver has just been on an absolute breakout tear. So if you hadn't known about that offer and it interests you, you can go reach out to Andy's firm about it by filling out the very short form at thoughtfulmoney.com/buygold. It is always such a great pleasure to talk to you, my friend. Thanks so much for coming on.
Always a pleasure, Adam.
And everybody else, thanks so much for watching.
China is buying gold like crazy. The people in China are buying gold. They love gold, and the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system, and they plan to build gold vaults in many other countries. Gold is clearly in a secular bull market. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000 to 9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable.
China is both the largest gold producer and a heavy buyer, with its people and central bank consistently accumulating gold as a hedge against the US dollar. China is building vaults abroad to back trade in yuan with gold, challenging the dollar system. China's central bank has increased its holdings of gold for 10 months in a row, ending in August 2025. Their gold reserves rose to about 74.02 million fine troy ounces. Gold is in a long-term bull market, and while a sudden surge to $8,000 to $9,000 within a year or two could signal a bubble, the current steady rise looks healthy and sustainable, pointing to much higher prices ahead. Florian Grimmies, a precious metals and cryptocurrency analyst and investor, highlights that central banks in China, Russia, and India are buying gold instead of Bitcoin, while the US is pushing into digital assets to maintain dominance, raising concerns about surveillance and sustainability. A World Gold Council survey shows 76% of central banks expect to raise gold reserves in the next 5 years. China has boosted its gold reserves for 10 straight months, joining Russia and India in favoring gold over Bitcoin, which remains too volatile and unrecognized as a reserve asset. Rising stagflation risks, low growth plus high inflation, are driving demand for hedges like gold and real estate. Analysts warn that while gold's inflation-adjusted price is at record highs, steady demand could lift it toward $3,700 to $4,000 per ounce by 2026. Tracking wealth in gold or Bitcoin, rather than just dollars, shows how purchasing power continues to decline. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
The Chinese, the Russian, and the Indian central bank are buying gold and not Bitcoin. The Americans desperately need something new to continue basically running their hegemony, and apparently they decided it's going to be the digital asset space. It makes sense to a certain level. At the same time, a digital dollar as a stable coin is just really much better. No, it's not. I mean, I'm very much worried about the whole surveillance kind of thing. I'm not sure if Trump himself really understands the whole thing. I think he has a lot of advisors who are telling him what to do and what to say, but if he really understood it, I don't know. It probably is the last chance that America can do, because they are not having enough gold.
You know, it's interesting. I read recently that Trump's assets, his corporate and family assets, have shifted from real estate predominantly to now crypto and Bitcoin predominantly.
Of course, it's amazing. I mean, who would have thought that, right? A year ago. To a certain extent, I would say yes. I mean, I think, first of all, the Trump family just wants to make as much money as possible.
Okay.
So that's, I think, the major intent here. And I think it's very questionable what's going on here. Very questionable. But at the same time, of course, I mean, the administration before was also extremely questionable because they were completely against it.
Yes.
Didn't allow any invention here and progress. So I at least that's what I appreciate now with Trump. But I think it's a turbo casino capitalism kind of style here. And Trump makes sure that his family makes a fortune here. And anything else, I don't know. Is it really better? I mean, yes, they create more demand for US treasuries if people buy more Tether, and then this is getting converted into the crypto market. Yeah, okay, but is this really sustainable? I don't know. I mean, the whole thing is more and more questionable in my opinion. Yeah, exactly. That's what's going on. On the one hand, massive expansion of the money supply, and not only in America, all over the world. If you look at these numbers for the European Union, if you look on Japan, on China, everyone is basically printing money. And on the other hand, the consumers are losing the confidence in these currencies, in these fiat currencies, because they see that they have less and less purchasing power. And so people are trying to escape into hard assets. And that's why, at the end of the day, real estate is still holding up rather well. Okay, there is regional differences, but overall, it's holding up well. And in many areas, actually, real estate is still getting more expensive. Your stock market overall, even though there's lots of questionable things happening in the economy, and you see that basically a stagflationary kind of scenario, the stock market is higher because people buy these stocks as an hard asset, so to speak, moving their money out of the fiat world. And gold, precious metals, mining stocks are moving higher, and crypto as well. And even your rare stamps and your old timers are getting more expensive because the fiat money is losing purchasing power and people losing confidence. I mean, you can see in many countries, the society is becoming rather unstable. Some of them are actually close to a civil war. These are all the consequences out of it, and this is just continuing. I don't see a turnaround. It basically says that on the one hand, central banks, politicians, increasing the fiat money supply, basically printing money out of thin air, and on the other hand, consumers and participants in these financial systems are losing the confidence because they can see that the purchasing power of their fiat currencies is diminishing by the day in the end of the day. And that's basically happening at the same time. And what it means is your assets or your investments can go up on a nominal basis, while in real terms they haven't moved at all. But people only look at the value of their assets in nominal terms, meaning in dollar. I mean, how many people are actually looking or calculating their net worth in Bitcoin and in gold ounces? It gives you a totally different picture over a 5 or 10 year time frame than just looking at it in terms of how many US dollars am I in total, or how many euros or Canadian dollars, right? So I'm doing this as a little homework every 4 months, updating a little Excel sheet, tracking my net worth, and you can see how challenging it can be actually to keep up in terms of Bitcoin and gold with your total net worth. You might have more euros or dollars, but not more Bitcoin and gold.
Florian recalls, in 2022, when the Fed hiked rates, Bitcoin crashed, and gold dipped but held much stronger as a safe haven anchor. Since its triple low 3 years ago, gold has risen over 130%, supported by 4 key drivers: expanding global money supply, the bond bear market pushing institutions toward gold, massive central bank buying since sanctions on Russia, and China's relentless gold accumulation for both citizens and reserves. China, already the largest producer, is building vaults abroad to back trade in yuan with gold, challenging the dollar system. This shift is unwinding decades of paper gold price manipulation, as physical demand now drives the market. Beijing is also making gold imports/exports easier. It's seeking feedback on streamlining licensing processes, longer valid licenses, more customs offices authorized, to smooth gold trade. China's consistent accumulation supports the idea that demand from major sovereigns is backing gold's secular bull market. The fact that China is pushing through regulatory/reform steps for gold import licensing underscores a long-term strategy rather than a short-term bet. Central banks globally continue with strong, steady gold purchases in the face of geopolitical risk, inflation, and concerns about US dollar reserve dependency.
First of all, in that 2022, when the Fed started hiking interest rates and everything came under pressure, Bitcoin went down to $15,800 from $69,000, and gold came down to $16,15 from 2070-ish. And had a triple low, more or less 3 years ago. But gold held up much better during that time than everything else. So I remember being very happy having a large chunk of my portfolio in physical gold, because it basically stabilized and was rather a safe haven anchor in that time when everything else was plummeting. So since then, gold is up 130% since that triple low 3 years ago. And you asked for the driver. So in my presentation yesterday in the morning here at the conference, I presented my take on it. I think there's 4 big, very important macro drivers for gold. The first one, I mentioned it before already, M2, money supply, the liquidity basically in the system, constantly being expanded over the last few years, and especially now again in the last few months. And not only in America, but also in the Eurozone, in Japan, in China, wherever you go basically. If you would look at South Africa or Brazil, you would basically see similar numbers. So liquidity expansion. Second big driver is the bear market in bonds, especially in the long-term bonds. So the long end of the bond market, I think the Fed has lost control over it already. We have still a rather persistent inflation. And if you're an institutional investor and you have to seek safe, conservative long-term bonds, and now you're in a bear market in bonds, it's very challenging. So I assume more and more institutional money will go into gold because it's the only other asset that they can buy. So that's the second driver. The third driver is central bank buying. We haven't seen that in like decades, that strong demand from central banks. Of course, it increased dramatically since Russia invaded Ukraine, when the whole world realized, like, whoa, the Americans, NATO, the Europeans just can confiscate our assets whenever, however they want. So now lots of emerging market central banks and nations are trying to diversify themselves out of the dollar, out of the euro, de-dollarization. Central banks are buying gold. They don't chase gold, but they also don't really care about $100, $200. So that's exactly what we've seen over the last 14 months. Whenever there was a consolidation in gold, you didn't really have a big pullback, because very quickly physical demand showed up in the market again. And the last one, which is also very important, probably the most important besides the central banks, is China. China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries.
Yeah.
So if they do their trade business with Saudi Arabia and they buy the oil from the Saudis, they will give them the renminbi, and the Saudis can take these renminbis, go in their own country, go to the vault, here's the paper renminbi, show me the gold. I mean, this is what the Chinese are working on, to inject confidence into their yuan kind of system, building an alternative system to the US dollar system. And that's not going away. Those four drivers that I just mentioned, I mean, they're going to be around for the next 1, 2, 3 years at least. It could maybe take a decade or even longer until this fully plays out. And I think during that time, gold will be strongly supported. There will be strong physical demand. And out of the consequences also out of those four drivers is that you are seeing now the unwinding of that 50 plus decade Anglo-Saxon paper gold Ponzi scheme kind of system, right?
Yeah.
So we know that in the past five decades, the price making or the price finding for gold has been dominated by trading 200 paper ounces of gold for 1 real ounce of gold. That's how mainly the price finding has basically happened. And this is being unwinded now. And this can take a long time. And again, I just mentioned it before, gold is super strong, no real pullbacks here, no dips, people chasing, running behind the train. It just pushes higher, and whenever there is a dip, immediately big hands showing up with physical demand. And I think it's super bullish. Gold is clearly in a secular bull market. I think the price targets that you and I were talking about 5 years, around $9,000, if you remember.
Yeah.
I think that's still the case. We probably have to revise them, and it's probably gonna go even higher. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1, 2 years, doubling in price immediately and running to maybe 8,000, 9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable, and we're going to see much higher prices. And this can last for at least a few more years, at least.
Could China's gold-backed trade strategy accelerate the decline of dollar dominance in global finance? How might central bank gold buying continue to influence prices compared to private or retail demand? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, thank you for being with us, and wait for the next updates.
First of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates.
With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes, while also not increasing public debt outstanding. Colin Weiss wrote in Official Reserve Revaluations, The International Experience on August 1st. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Noting this scenario, the speaker, Clive Thompson, highlights that the Fed isn't guaranteed to pick a revaluation target of $15,000 per ounce. They might even use the spot price instead. The Federal Reserve published a research note titled Official Reserve Revaluations, The International Experience. The paper examines 5 countries, Germany, Italy, Lebanon, Curacao, Sint Maarten, and South Africa, that have revalued gold or foreign reserves to bolster their finances. The Fed has not committed to a specific revaluation figure, such as $15,000, using market prices, is still on the table. The study examines how other central banks have utilized revaluation proceeds to offset operational losses or provide government financing. However, the US has yet to take such a step. If revaluation occurs, then this paper profit could be converted into gold certificates and handed over to the Fed. The Fed could then credit the Treasury with new dollars, allowing the government to spend without officially increasing its debt. This is why some refer to it as a hidden financing tool for the state. Central banks have different methods for valuing their existing bullion holdings. Some value their gold reserves at their historic cost, others report it at current market prices, he said. When central banks report their holdings at current market prices, fair value, the unrealized profits or losses from valuation changes are recorded. When gold is valued at historic cost or modified historic cost, gold reserves can be revalued at market prices or values closer to market prices to generate revenues, he noted. When all official reserves are valued at market prices, the unrealized valuation changes recorded in the revaluation account can be shifted to other. Now, we present the clips from the interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
First of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates, which is not part of the USA debt, doesn't have any interest, and has no maturity date. So what they're basically doing, if they do a revaluation at any level, they are swapping the debt that they have at the moment, or some of it, for gold certificates, which is not debt according to the official the Treasury balance sheet. Now, as I said, the higher the price they do it, the better it is. So I picked a figure out of the air of 15,000. I kind of felt my figure was on the low level compared with some other people who've been picking 20,000. But of course, the level at which they'll do it, if they do it at all, would be at what level do they dare to do it without disrupting the market? Because we don't want to, well, they don't want to do a figure which is going to make people panic and say, "Oh my God, the dollar's worthless because they've done this." So I kind of chose that number based on what I thought would be a right number relative to the amount of money they've been printing in the past. As you know, they're printing roughly $2 trillion a year effectively in new debt to pay for the budget deficit. So the figure I picked of $15,000 would cause a new printing of 3.9 trillion as opposed to the 2 trillion a year which is being created. So that would be very, very slightly inflationary, not much. I mean, let's face it, with the amount of money which has been coming into existence over the years, it's not a big deal. For example, it's only about 10% of the national debt. Well, I think if you're buying physical gold and silver in the form of coins and bars, the thought process ought to be one of, I'll keep it forever unless there's no choice. So it's kind of like an heirloom. It's a bit like if you buy a painting, you put it on your wall and you expect to pass it down the generations. Obviously, it's an asset which can fly a little bit under the radar screen, which can be advantageous depending on how you look at it as well. So when I buy physical metals, I tend to think that I'm not buying them with a plan to sell tomorrow or next week or next year or 5 years or 10 years or at any price. It's kind of like the parachute you've got just in case the worst comes to the worst and you've got no choice. But if you want to trade in and out of gold and silver, then the way to do it is the way, I know you don't like it, Mario, but the way to do it is through ETFs or gold mining shares or things on the stock market where you can trade with a very narrow spread and at high speed. But that's a completely different kettle of fish from having a parachute. Trading is where you buy something with a plan to sell it quickly and make a profit. Whereas I think the reason why a lot of people are choosing to buy gold these days is because they fear that the financial system that we are in is getting close to the end. I fear the trust in fiat money could evaporate very quickly, and then they might be forced into a new system. And if you own a gold coin before we cross that line, you'll still own it afterwards. Whereas if you've got something in custody, subject to the whims of a third party, you're not sure where you're going to stand. You're not sure if they're going to take it from you.
Francis Hunt, also known as Market Sniper, points out that a significant revaluation of America's gold reserves could instantly boost the federal balance sheet by recognizing hundreds of billions in previously hidden assets, thereby improving the debt-to-asset ratio and bolstering confidence in U.S. bonds and the dollar. By providing extra backing for government obligations, it could help address record-high sovereign debt while reinforcing gold's role as an inflation hedge, signaling limits to currency debasement and strengthening trust in U.S. monetary stability. Despite its potential benefits, gold revaluation would likely trigger significant market disruptions. Financial markets have operated for decades under the assumption of fiat currency dominance, and an essential shift in monetary policy could lead to substantial volatility across asset classes. Revaluation might paradoxically create inflationary pressures if implemented too quickly or without careful communication. The sudden recognition of additional national wealth could alter inflation expectations and lead to accelerated price increases in the short term. Major gold holders, such as China and Russia, who have both been actively increasing their reserves, would likely react with deliberate actions to capitalize on a more gold-driven monetary environment if the U.S. were to revalue gold. A comprehensive legal and regulatory foundation would be required for such a change, including congressional consent, coordinated action by the Federal Reserve and Treasury, and a clear implementation strategy. The foundation for this strategy may already be in place, according to recent Treasury remarks on asset monetization. Growing awareness among financial professionals and officials highlights gold's potential as a significant instrument for addressing America's debt issues, although the timing and scope of any adjustment remain unknown.
What does history show us on revaluation conduct? It shows us that government has no interest in making its citizens wealthy. What did they do previously? Roosevelt got everyone out of the metals by decree, by threat of law, massive fines that would run into millions today. It was tens of thousands back then when you bought houses for that kind of money, and multiple years in jail. What did the events of COVID tell you about their approach? They're in it to enrich themselves. You weren't given the heads up of something coming, then everyone's speculating and all jumping into farmer shares. They took the money and they closed your businesses down. What do the possibilities of the great taking tell you? The possibilities of the legalese versus the English show. When you understand where they're seeking to take us, and this is my conspiratorial nature, Clive might think, but we are looking at a global communism and totalitarianism to make everybody reliant on UBI, as large a segment of the population as possible, so that you ultimately control them. If you control the food supply and you control how they earn and what they can eat, you have the end goal that I believe these people have always sought. So the lottery hope of a 4x, 5x, 6x on gold that will benefit quite a reasonable sway. Now, as we say, hedge funds don't really have a lot of gold, but there is still in the liberty movement quite a high tendency to stack gold and silver, that their greatest enemies, and believe you me, libertarian people who seek self-reliance are invariably the biggest enemies of a totalitarian state who's seeking a great leveling in the Western markets. You are not likely to get this lottery ticket. And I don't want to be the guy behind hopium on this for a number of reasons. However, truth does out, and I think the option of a mark-to-market is far more likely, and the force of necessity and the inflation that they're going to be generating could see Nixon-esque regular mark-to-markets to open up the overdraft out of force of necessity, which probably means they'll go either for a similar confiscation or other aspect, which is a bit draconian, but depends how totalitarian we get. We're being told a lot what to do, but they can also do their unrealized capital gains, which is what probably my primary scenario, where they can enforce sales by instituting an unrealized capital gain on you. So they want to know what you have, so you're going to have to blockchain it. I would suggest maybe having some gray or black gold, which would be off-grid, illegal, and probably punishable by death, given that they're the Marxists that they are. And you probably will face capital gains tax even if you have not sold, just by virtue as they know we're patient stackers. That's how they have a plan for gold and silver, guys. Without a doubt, and they aren't going to enrich us without a clawback or an attack vector. And it's not good news for me to say that. Don't shoot the messenger. I'm just very clear about what history tells us about the kind of people we're dealing with. They do the revals after they've stripped you out. And if they're not going to be able to get away with doing that now, they're going to make sure they get their pound of flesh out of you, the Shylocks that they are. So that's my take for the question. We've got to watch for those attack vectors if they do end up giving you a decreed new price that isn't price discovery. There's a lot of legalese that will have to be negotiated. I don't believe they'll be prepared to bankrupt the banks, their shareholders. And I don't think it's a high probability, and don't get sold on hope, because then you don't get the crash of the disappointment. Mark to market is far more feasible. And I think it could regularly be mark to market, because once they do it once, it becomes the tap that they keep dribbling the drops out of and getting sustenance. So it could be repeat. And I think you should keep doubling down and keep giving them back their fiat and keep stacking. And you should have locality optionality so that you don't get taxed out of your metals. And that's what we do for our community very specifically, because it's not just what you make, it's what you get to keep.
A revaluation of US gold might reveal enormous latent value in the country's reserves, enhancing fiscal stability, fortifying the dollar, and indicating a cap on unrestrained currency production. To prevent market turbulence or inflation shocks, such a move would necessitate rigorous coordination between the Federal Reserve and Treasury, a precise legal foundation, and a well-managed communication strategy. The ramifications would be seen globally, changing monetary policy and potentially hastening the transition to a financial system that is more heavily reliant on gold, with big gold-holding countries like China and Russia ready to react strategically. What short-term effects may a gold revaluation have on international financial markets? What legal and practical measures would the United States need to take to carry out such a revaluation? Please leave a comment below with your comments on Clive and Francis's gold revaluation analysis. If you find this video helpful, please give us a like and turn on notifications to stay up to date with our latest videos. I'll see you in the following video. Thank you for viewing.
That we're still at above 2.5%, close to 3% in the US inflation, consumer price acceleration rate, and the interest rate has been being cut since 2024. You can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case. This is going to be much worse for the dollar, and it is going to be the end of it because the debt is so much higher now. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
U.S. inflation remains near 3% while the Fed continues cutting rates, pushing gold higher alongside rising consumer prices. This policy shift is set to hit the dollar hard, given today's much larger debt levels. Analysts warn that endgame is near, worse for dollar holders than in 1980, but far more rewarding for gold and silver investors, as this time gains are expected to be sustained and even surpassed. Rafi Farber, known as the endgame investor, is a financial writer, investor, and precious metals analyst. Recalls that back in 1980, the Fed fought inflation by targeting monetary aggregates, money supply growth rather than just consumer prices. With debt to GDP at only 32%, they could hike rates aggressively, eventually taming inflation and stabilizing the dollar. Today, however, debt to GDP is near record highs at around 120%. Leaving no room for similar rate hikes. Instead, the Fed is cutting rates into rising consumer prices and a rising gold market. Unlike 1980, this environment signals a much weaker dollar and far stronger prospects for gold and silver, with gains expected to surpass those of the past. Remember to hit the bell symbol and subscribe as we begin the video so you don't miss any updates. If you like the video, please leave a comment below and give us a thumbs up.
They wanted the monetary aggregates is the M1, M2, M3 money supply. This is back at the time when the Fed was actually trying to control inflation in a classic sense. Inflation meaning the amount of dollars over the gold supply, how much the monetary aggregates are actually rising. That is inflation in the classic sense, just as they changed the inflation to the effect of inflation, which is the effect on consumer prices, just as they changed the definition of vaccine to what it was before and what it is since COVID. I'm not going to go into that now, but it's the same kind of Orwellian nonsense. But this is back when the Fed actually was not actually fighting inflation, but trying to control inflation, meaning the actual monetary aggregates, the money supply numbers, not the effect on prices. They didn't care, not that they didn't care. It wasn't their primary goal to change the effect of prices, of consumer prices. They knew that if they attacked the monetary aggregates and controlled the expansion of the monetary aggregates, they would, by extension, control consumer prices, which they did in the end, which is why we still have a monetary system as it was in 1980. So basically, at this point, the Fed is jacking up interest rates in order to control monetary aggregates. And we can see here by this chart, when they hike into the maximum, exactly when this is, I think this is early 1981 or something like that, once they see that the monetary aggregates are within the growth ranges that they prescribe, then they get control over consumer prices over here in the red, and they get control over the gold price. But this is, of course, not their primary goal. They want to control the monetary aggregates, which will control the consumer prices, which will also control the gold price by extension. And then they start cutting rates once they see that this is under control. The other reason why this is not a 1980 situation is that you can see the debt to GDP ratio. I know GDP is fake, but this is still a general relative number that does convey some information. The debt to GDP ratio in 1981, when interest rates were at a maximum, was 31.8%. This is, I think, an all-time low since Andrew Jackson, maybe. Maybe I'm exaggerating that. I didn't look into the 19th century. I can't find statistics for debt to GDP ratio in the 1800s, but you can see that this is the lowest debt to GDP ratio. This is precisely when gold was topping and when inflation, consumer price inflation, was topping out. This is why they could jack up interest rates so high, because the debt was so low by comparison to any other year from World War II, at least before World War II, the Great Depression, until now. That is why 1980, the dollar survived that turbulence. But now, of course, we are at 120% or whatever it is, the very, very near an all-time high in debt to GDP. There's no way that they can raise interest rates now, which is why they're cutting it, and they're cutting it into rising consumer prices. You can see here, this is the chart of the interplay between the U.S. inflation rate. Inflation, I mean in quotes, not really the inflation rate, but the consumer price acceleration rate. And gold you have here, I don't know why it's not in gold. What is that, gray or green or whatever the hell it is? And you have here the blue U.S. interest rate, the federal funds rate, and you can see here that we're still at above 2.5%, close to 3% in the U.S. inflation consumer price acceleration rate, and the interest rate has been being cut since 2024. You can see gold is rising because of that, or in tandem with that. So now we are in an environment where, first of all, the Fed is going to cut into accelerating consumer prices, and they're going to cut into an accelerating gold price. That was not the case in 1980 at all. So people that say you can't compare to 1980, this is not that situation, stop using those ratios, I agree. This is going to be much worse for the dollar, and it is going to be the end of it, because the debt is so much higher now. And unlike 1980, when they were cutting into a falling consumer price inflation environment, now they will be cutting into a rising consumer price inflation environment. And while debt to GDP was so much lower in 1980, it was lower than any time before World War II since the Great Depression. Now it is at an all-time high. There is nothing they can do. They have to cut into rising consumer prices because the debt is so high. Where in 1980, they didn't have to do that, and that's why they saved the dollar, and that's why they will not this time. So forget about the Hunt brothers. The end game is coming. It is coming soon, and this time is going to be much worse than 1980 for dollar holders, and much better for gold and silver holders, because this time the gains of 1980 will be held and exceeded.
Rafi Farber points out that in 1980 and 81, U.S. inflation and gold prices were surging while the Fed raised interest rates aggressively to regain control. After briefly cutting rates, they were forced to hike again up to nearly 15%, when money supply growth ran hotter than expected. Only once inflation consistently declined did the Fed start cutting rates steadily, which helped stabilize the system and prevented the collapse of the fiat dollar. Now let's review the interview.
And so here we have a chart with three colors, blue, red, and some kind of yellowish, greenish, orange, whatever blah that is. You can tell me later in the comments how stupid I am at colors, but whatever. My eyeballs are my eyeballs. What can I do? So this one, which I think is the red one, is the U.S. inflation rate. This one, the blue one, is the gold price. It's not exact. And this one over here, this wobbly one is going down over here, and then back up. Blah, blah, blah. That is U.S. interest rate, meaning the Fed funds rate. Now, what was going on here in 1980? What was going on was that interest rates were going up and up and up and up, because the U.S. inflation rate, the inflation in quotes, the inflation rate, meaning consumer prices were rising. They were rising and rising and rising. And so the Fed was raising and raising interest rates, but not quite. We'll go into why not quite. That's not what was happening in the next slide. This was a situation where interest rates are rising, gold was rising, the inflation rate, the consumer price inflation rate was rising. And then you have this period here where they were cut, the interest rates were cut back down here to whatever that is, I think 5%. And then they were jacked right back up to about 13, 14% right here. And we'll see exactly why this was in a second. But you can see here that the Fed was trying to quash consumer prices, not exactly consumer prices, we'll see why in a second. They were trying to quash something else. And as they were doing that, finally, when they got control of the US inflation rate, when the red line started going down, that is when they consistently started cutting rates over here in this greenish, yellowish, whatever line that is. And you can see here that the gold price was falling with it as well. What I'm trying to say here is that back in 1980 and 1981, the Fed was raising rates, trying to quash consumer prices, and only once they accomplished this goal and they saw that the inflation rate was falling consistently, only then in 1981 did they start cutting rates on a consistent basis as consumer price inflation was falling, as the acceleration in consumer prices were falling. So in other words, the Fed already had control of the inflation rate when they started cutting on a consistent basis. That's what happened in 1980, and that is why, one of the reasons why, the fiat monetary system did not end in that year. This is not really a chart. This is a transcript. I will give you the link in the description below as to exactly where you can find this thing, and it's on page 7 of the PDF that I found it on at the Federal Reserve's website. This is to a staff analysis, says the Federal Reserve Board. The demand for money had been quite strong in recent months because of recovery in economic activity and in nominal GNP, not GDP, GNP, slightly different, had been much larger than anticipated. Growth of transaction balances was projected to slow significantly over the remainder of the year, in part because of the lagged effect on the demand for money or of the sharp rise in interest rates over recent months, and in part because of the apparent weakening of the recovery in activity. In the committee's discussion of policy for the period immediately ahead, the members generally favored pursuit of a sharp reduction in monetary expansion from the rapid pace of recent months. And so, if we go back to this chart over here, this is November of 1980 when they started to raise rates again after cutting them over here. This is 1980s around here where I'm circling when they started to raise rates back up to the maximum around 15%. Why did they do that? Because they saw that the monetary aggregates were rising at a faster pace.
Unlike 1980, when the Fed had the flexibility to crush inflation with aggressive hikes, today's debt-heavy environment leaves policymakers with fewer tools. Cutting rates into rising inflation risks undermining the dollar while fueling gold and silver to new heights, suggesting this cycle could deliver far more lasting gains for precious metals. Could today's debt levels make it impossible for the Fed to repeat the 1980 playbook? How high might gold and silver climb if the dollar continues to weaken under current policies? Please feel free to leave a remark below with your thoughts. Please give this informative video a thumbs up and subscribe to receive our most recent updates. Thank you for joining us on this trip,